started, almost 40 to 50 banks or institutions in US, EU, UK, and Iceland, they went bankrupt. And my team actually has gathered all the names of the institutions and they have put them on a chronological order. And it goes from 2007 to 2014, with the last bank being the Banco Espirito Santo. Exactly. So the reason I wanted to show this table is that obviously it is a very severe crisis. It has raised a lot of questions on the key pillars of finance. And the big question is whether the next financial crisis can actually be averted. But I think that the speakers are going to touch on this. And you have the first speaker, Despina.
You will be happy to know I have no slides to show you. Oh, this is not necessary.
You just have to see.
Yeah. I don't have very beautiful slides to show you like the other colleagues. I wanted to start off like with the other speakers by thanking the organizers, and I know that this is what you do in a presentation like this, but I really mean it, and I will say this because with some of the organizers we did our doctoral studies together in Florence. But what they don't know is that at the time I had trouble getting my PhD position there because of my topic, as I found out afterwards. My topic was essentially the banking union, the legal aspects of the banking union, which was then called the single supervisor, single regulator dilemma. So at the time I never would have thought that I would be invited to such a beautiful conference and such a beautiful location. And perhaps some of you know the Nobel Prizes. They are about alternative prizes to those who do research which is completely useless, like a penguin, I don't know, pool or something like that. So for me this is a double happiness to be here. Jokes aside, what this shows is that ultimately a topic which used to be so technical and so niche is now making part of discussions about the future of the European Union as a whole. So I think this is something to already take in mind. But because now the topic has become so fashionable, those of you who have been looking at the banking union or know something about it, there have been already so many people who wrote about it. So I was trying to think for myself what I could bring to this intervention that is useful to you. But as I realized, this conference is not for specialists of banking regulation, I thought that I would structure my outline first by starting speaking about the rationale, the background, so what brought us to banking union, why do we need banking union? Then very briefly outline it, very briefly. But by having explained the rationale for why we need the banking union, I'm hoping that perhaps you will already see the arguments that we bring forward, both the EBA as an institution and myself, about why this is a positive development. But then I'll touch on a couple of problems with the design so far, and I'll propose that the EBA can, of course, resolve some of them. So let me start by speaking about the rationale for the banking union. To understand it, I think we'll have to go back. Indulge with me, I won't go too far back, but I will invite you to understand, to think what would be a rationale for creating a single market in financial services in the union. You're an economist, I'm a lawyer, I don't know if I said that or not, so bear with me if I'm not particularly precise in my words, but essentially the idea was to ensure efficient allocation of capital around the EU. So if there were surplus in the bank's deposits in some part of the union, it could be put to useful, it could put to good use in helping the development in other parts of the union where they need it. So that is a very general approach. But how did we manage? How did we approach? How did we try to establish a single union in the financial markets? Essentially, the process was the same as in everything that the EU did, the European communities and the EU. So, because the harmonization of absolutely everything was impractical and politically impossible, we went through a harmonization of essentials, and then try to use what is called the regulatory competition for the rest. What did this mean? Essentially, we created a market for the states where markets would compete and would try to hopefully attract more banks in their jurisdiction by improving, hopefully, their standards. But so that meant that we started off, as almost everything in the EU happened, we started off with some, what you, I think also political scientists call negative integration, so trying to remove the obstacles. And then later on, we passed to a phase of actual, real regulation. In my case, I'm interested in prudential regulation for the banks. So, and the latest result of that is the CRD or CRR, Capital Requirements Regulation, Capital Requirement Directive, and the fact that this is a CRR, it's a regulation, which means that for those of you who know it, regulations are immediately Greek law, Italian law, Spanish law. They become part of the national jurisdiction, national legal orders. So, but what else did we do in the Union? We decided that we'll separate monetary competencies from the banking supervision. That was decided early on. But what then happened in the banking financial regulation and supervision? We had another split there as well. So banking supervision remained national, and we tried to harmonize some parts of banking regulation. So the production of the rules became partially an EU level task. Partially, I repeat that. But the latest proof of that was also the creation of my authority, the European Banking Authority, and the contribution to what is now called the single rule book. But I'm diverging, so in order to come back to understand the rationales, the need for a banking union, I'll invite you to think that all of what I described up to now created the basics for moving towards a single market in financial services. So what was the message that it gave to the banks? It gave the message that this is one market, the whole of Europe is one market, so it gave incentives to banks to expand within the market. How could they expand? According to EU law, they can offer cross-border services, or they can offer services via branches and subsidiaries. The difference legally is that a subsidiary is an own legal entity, whereas the branch isn't. We saw in practice that in reality the cross-border provision of services didn't really catch up in the banking sector, because this is an area, I don't know if the bankers have a different view, but that was our understanding, because probably this is because this is an industry that relies a lot on trust and on relationships with the clients. But why am I speaking about this? Because the result of these incentives to the banks was that we had a wave of mergers and acquisitions. So we started seeing big banking groups forming in Europe. And here is somewhere where I could have had a nice slide to show you, because there is a part of the Lee Cannon report for which some of my colleagues are speaking later today, I understand. In any case, it is a report, you will know what it is about, but it is a report that compared European banks with American banks in terms of their assets compared to the size of their let's say the economy. So in America, rather I should put it like this: the European banks, when you compare their assets to the GDP of the union as a whole, which is the actual market, underlying market, is similar to what the US banks ratio. But when you then move to look at their assets compared to their sovereigns, the GDP of their country, this is a huge difference. So why am I saying this? Because we ended up creating big banking groups that were big in terms of their sovereign. Remember this, I'll come back to that. They were big in terms of their sovereign. In all that I said, perhaps you noticed that I spoke about banking regulation, banking supervision, but I didn't speak about banking resolution. And this is because in Europe this was never, until recently, harmonized. So what happened when the crisis came? When the crisis came, there was at some point a discussion in the policy circles about trying to save banks in trouble at the European level, meaning together finding a solution at the European level. But this was seen as unacceptable, because it didn't link together very well with national supervision. So we stayed with the idea of national resolution of banks. So if a bank needed to be saved, which is something that I don't know about, the economists and practitioners will say when that is the correct moment, but when the bank needs to be saved, it would have to be saved by its sovereign, essentially by its country, the country where it's incorporated. And there were two results coming out of this conclusion. Imagine if you are the counterpart of a bank in an interbank market, which is essentially where the banks go to find a larger part of their funding. They don't just get funding from you and me when we put our deposit. So if you're a counterpart of a bank in the interbank market, but you start off thinking that each one of my counterparts functions around the EU, and it's an EU banking market, it's fine. But once you realize that ultimately if this bank is going to fail, it's Greece who's going to save this bank because it's a Greek bank, then you start thinking that in order for me, you start depending the cost of the funding to this bank, you start linking it to the sovereign. So this is the famous, if you have heard of this, many people refer to this as the sovereign loop or the sovereign link or the vicious circle of linking banks with their sovereigns. But this also meant that if a bank actually, which due to the crisis many banks found themselves in trouble, they could only turn to the sovereigns for help, for support. And of course, this is where it comes what I told you a bit earlier. Of course, because we had the situation where earlier we had given incentives to banks to become big, there were some banks which were bigger than their sovereigns, or what their sovereigns could put on their shoulders. So they put further pressure on the debt of their sovereign. And of course, because in these cases the banks usually also buy the debt of their sovereign, this started becoming an even bigger vicious circle. So now, on the other hand, what I just described is what happens outside the bank, so how the others treat you as a bank. But what if you're the bank yourself? If you see this is the situation, and you know that ultimately you will be saved by your national government, what are you going to do? Knowing, even though you're a group and you have expanded in the previous period, you will start now functioning softly on national lines. Without breaking up the group, you will still adapt to different local requirements. So we also saw that as banking, European Banking Authority, we saw that soft breakup. But what we saw in practice even more was how the national banking supervisors reacted to this whole situation. Because now think, the way it works in the European Union is that if I'm Greece, I'm saying because that's my nationality, and a French bank, do we have a French one? Yeah, I think I do. So perhaps that's safer. So if a French bank wants to come to Greece to open up a branch, then I will be the so-called host authority. And I'm able to supervise parts of the activities of this bank in Greece. So the rest of the activities, from the prudential point of view, the rest of the activities of this bank, how much capital it has and how well it is governed, etc., is governed by France. Now I'm painting here with very large brushes, so there are many exceptions to that, but roughly this is how it works. So in the scenario that I described, what is the ultimate result? If I am the home authority, so if I'm France, and I know that in the end the local regulator supervisor will take the blame for having their local government pay up, I don't care about what happens to my Greek branch. So I'm generalizing. If I'm the host supervisor of the bank, I will try to make sure that the bank in Greece has extra assets on which I can, claw and on which I can tap in if I need to, so as to avoid to go to my to the taxpayers' money. So, in essence, what I'm trying to get at is that during the crisis, what we saw was a loss of trust between the supervisory authorities, the national supervisory authorities, which we had tried hard to build up until then, both as SEPS, which was the predecessor of the meeting of EBA, and as EBA when it became an authority of the European Union. So, in essence, what I spoke so far about was the sovereign loop. Remember I said the connection of the bank to its sovereign, and this is what many have called the balkanization of the single market, so essentially the breakup of the single market. You will tell me then, but what was the EBA's role in that whole context? We did try, and we did actually do many actions which we believe help avoid especially the breakup of the single market, but unfortunately, we cannot publicize them because these are soft law tools, so and they build on ensuring restoring the trust between regulators and supervisors. Is the correct word. So essentially, we did have cases where we had the sort of a scenario that I told you: a host, a supervisor. Oh God. A host supervisor and a home supervisor disagreeing, and we did try to achieve mediation and find a solution. We did look into investigations for breach of EU law, and you will tell me, so what happens? It is a soft law, like I said, it's a stick. It was a threat to, let's put it like that, to national authorities to try to cooperate further, because nobody wanted to be seen as breaking the law. And we did urge cooperation in the so-called colleges of supervisors. So in groups of banks, there are different, so if there's a banking group around Europe and it has 3 or 4 supervisory authorities, they meet together and they take decisions for the whole group. So we did our job through that process, but as you can understand, this process has limits, because up to a point it's a bit voluntary. It can always be reversed. It's not anything permanent. So why did I say all of what I said? As an introduction to what is the banking union, but also to already base our, justify our approach to the fact that we are welcoming this new development. And as CBA and personally, we view that this is necessary because by the mere fact that there is a European supervision, you already take the burden off. Remember what I said in the beginning, you create incentives, you say, oh, if I know that this guy will be saved by his country, I'll be more careful about how much I lend to him or at what cost. So if you know there is a European supervision, and especially if you know there is a European resolution, this incentive already goes away. So the idea, at least, of the banking union is that, at least for this, especially for the sovereign loop, that there is lots of hope that it will be able to make it go away. But how about the second aspect, ensuring that we avoid the balkanization, the split up of the single market? In there, we have, let's say, a few doubts that it can work to the full extent. I don't have the time to go through everything that the SSM is about, but essentially the SSM single supervisory mechanism is one part of the banking union. Like I said, some of my colleagues are going to speak about the resolution. But the SSM is a mechanism, it's not a new authority, but it is a mechanism whereby the ECB has some, again, I'll paint with very large brushes, but the ECB has exclusive competences over giving licenses or taking back the licenses of banks, and essentially for the prudential supervision. But there are some issues, and the issues that we have are, first of all, that even if you only look within the SSM, so the countries which are going to participate in this SSM mechanism, I forgot to say, are in the first place those of the Eurozone. So that's another reason why we've been speaking about balkanization of the single market. I'll come to that in a second. So within the SSM, so the ECB will have power over direct supervision over the big banks. And again, I'll paint with very large brush. The big banks around Europe and the big banking groups are going to be supervised directly by the ECB. The smaller ones by the national authorities, but the ECB will have ultimate decision-making power if needed. So what are the problems that we see in terms of breakup of the single market. The main problem is that there are differences in the supervision of national, so national supervision is still national, even within the SSM, and the reason is, and this is where the legal mechanics become very important sometimes, the reason is because it's only the supervision which is harmonized, but not the regulation, okay, not the rules, which means that the ECB, when it applies EU legislation, which is open-ended, so it allows discretions to member states, when it supervises a bank, which is Greek, it has to apply Greek law, so the Greek national discretion, or that part of the EU law which is not harmonized. I see a confused professor at the MARKT. No? Okay. No, but sometimes it's very confusing because you cannot very easily see the line between what has been harmonized and what is up to the national discretion of the national authorities. And as a lawyer, I'm very often called to just opine on such a division of competences which was designed to be unclear. So this is one major issue. I know that I have very little time. I have to end, yes. So I'm getting to the point that I wanted to develop a bit more, but the point is that even within the SSM there are these differences and these divergences. But of course, I call you to remember that this is the SSM applies only to the Eurozone countries, or those which want to opt in. As it looks, from what it looks, there's no chance that at least one member state will opt in. So we might be very sure that there's always going to be at least one outside the SSM and the SSM. So for us, this means balkanization of the single market. On top of that, and that will be my last point, is that, and my colleagues will speak about that, I'm sure, that in the resolution area, we also now have the SRR Single Resolution Authority and Fund, and there is a corollary to that, the Bank Recovery and Resolution Directive. But I'm sure that we'll all agree that this directive gives very big discretions to the national supervisory authorities again. So we view that the role of DBA in that respect cannot be underestimated, because it is within DBA where this balance between the SSM and the rest of the SSM is going to be achieved. And not only by us helping draft the regulatory technical standards which the Commission then adopts and become legislation in all our countries, but also by a new thing that was introduced in our regulation via the SSM regulation, which is the single supervisory handbook. So not just the rules, so the single rule book in general is that refers to the rules about how much capital a bank can hold, how much liquidity it should have. But the single supervisory handbook is about agreeing when you do have a problematic situation and it involves value judgments for you, the supervisor, which way should you go, how you should judge what you see in front of you. So we view that our role in that is going to be very important. I promise this is the last phrase that I will say. As a lawyer, I'm a bit unsure about what that single supervisory handbook means, because if you look also at our regulation of the SSM, it becomes evident that it's not really a guideline, which is already soft law, it's not really binding. You might be wondering what is the effectiveness of all that and whether this can work. I will argue that I was one of those who never believed that this soft law can work. I worked for the new governance project at the UI with Professor Etienne and others, but I've come to see that in practice, and at least in our sector, where you have to take very quick decisions and you have to adapt very quickly to the needs of the market, this can work. So I'll leave you to that. There were more thoughts, but perhaps I can catch up during our discussion. Thank you.
Thank you, Despina. The next speaker is going to be Mr. Karel Lannoo, CEO of Center of European Policy Studies.
Okay, thank you. Pleasure to be here. And I think what I will be covering is very complementary to what Despina has been saying. I'm not a lawyer, I'm not nor an economist, I'm a historian, but basically I've been following financial regulation for probably 20 years, so don't worry. You can cope with it, even if you're coming from outside. How should I set this up? Let's say I need to go to my presentation. Also, initially I thought, like Despina, not to have a presentation, but then I think, let's say, because of the numbers which you mentioned, it's probably easier to have a presentation, to see it in front of you, all the things we're speaking of. It's okay. So I come from SEPS in Brussels. For those who don't know SEPS, we are a think tank. I direct SEPS since about 14 years. We work with about 60, 70 people. I don't know whether we have Greeks at the moment. We certainly used to have some, but I don't think so for the moment. But we have about 30 nationalities. And we are about the largest think tank in Brussels at the same time. The title of this talk is a bit difficult because it says, yeah, will the next crisis be averted, and then institutional responses and macroprudential regulation, which are basically, to some extent, not entirely the same things. You have the institutional response, which is basically what Despina has already been explaining, that's the banking union and all the rules which we are having in place, but also macroprudential regulation is one of the elements of the response, and it's part of regulation, but also part of the institutional response. So I try to clarify this a bit, but also at the same time, I will try to sketch you a bit the context where we are, because I think, and I will try to come back to this at the end, the biggest challenge which we have today, and it's also to some extent related to macroprudential regulation, is we are in a context of stagnation. So we have almost deflation overall in the Eurozone, probably 0.5%, but some countries like Greece, like Portugal, like Italy have deflation of minus 0.2, minus 0.3. Extremely difficult environment for banks, which poses for the ECB the question what to do. Of course, from a macro perspective, the ECB can say deflation is boom, more liquidity in the market. But from a bank perspective, deflation can be killing, because a bank earns almost nothing on its, certainly on the short-term credit, for example, in the interbank market, the corporate market, short-term treasury earns almost nothing. So a bank doesn't look at it in real terms, look at it in nominal terms. If you look at, for example, the Ionia rates or the Euribor rates today, we are at 0.2, 0.3%. Imagine if you're a treasurer of a bank and you have to deal with this. So look at this back from the perspective of the ECB. ECB takes over supervision in about a month time, and is faced with a task. The banks are very fragile, but the economy is very fragile as well. So on the one hand, I have to clean up the banking sector, but on the other hand, I have to stimulate the economy. And how can I do both at the same time? I don't have the answer to this, otherwise probably I wouldn't be standing here, I would be standing somewhere else. But I try to sketch you the context. And probably this is just as a reminder, what is macroprudential supervision? Just, if you can speak about, as Despina said, you can speak about regulation and supervision. And within, say, regulation and supervision of both, you can speak about micro and macro. Micro is basically supervising a bank, an insurance company, securities firm, and the day-to-day handling and things which they can do and cannot do. And you can do prudential supervision and conduct of business supervision. Macroprudential regulation is looking at the economy overall and prevent, like what has happened in Europe in several countries, asset bubbles, like, for example, most well known in Spain, too much credit growth, which was almost the case for all of the EU. Smoothen the cycle, make sure that there are not too much ups and downs, and of course prevent contagion. So, but I mean, overall since the financial crisis, there is an agreement that we need to do macroprudential regulation, that we need to have these tasks to macroprudential authorities, but there is still a lot of disagreement, a lot of papers also in academia, you can see this in websites, on how should this be exercised, this task. They say it should be a task of a macroprudential authority. We have in Europe the ESRB, European Systemic Risk Board, which is in charge of that. But how should it act upon this? So we can say, look, we see a credit bubble, but how do you act on it? Will you all of a sudden say, yeah, we need to raise taxes on, for example, property investments? Yeah, some people may say agree, but then you will have local authorities reacting, you will have others saying, no, that will be bad for employment, and so on. It's extremely difficult. That's why if you act on the macroprudential side, I think the results will always be suboptimal. But look a bit at what we're in today in Europe. These are data which I took from a French bank, data until the middle of the year. And basically, the overall perspective is still very preoccupied. So meaning you're sitting in the seat of a Minister of Economic Affairs, somebody from the central bank, and you see basically credit growth, I mean, the north of Europe there's no problem, south of Europe is still declining. Big problem. And then on top of that, you see the cost of credit in the north of Europe declined, and the south of Europe is still very high. So, do we have a single market? So, these are data until, what is it, May, June? And you don't see it here, but they are until May, June, as it is there. So, we have a very disintegrated market. Then you have to act as an ECB with a single monetary policy, but you're confronted with this perspective. You're confronted with the issue that the transmission of the monetary policy is very uneven all over the EU, and you have to keep it together. So good luck, Draghi, try to do it. Another issue, I mean, we're speaking about single rule book, we want to integrate these markets. I mentioned, let's say, how disintegrated they are. Let's say we look at the, for example, bank lending. You can also look at other indicators which the ECB has been following about what they call, I mean, a synthetic indicator for market integration. We are, according to these ECB indicators, today at the level of market integration, which is what the cross-border holding of securities, cross-border investment, cross-border bank loans. There are 4 indicators which they are using, which they are compiling since the start of monetary union. We are at the level of 1999 today. So these data were published by the ECB in April. They each year do this market integration report. ECB, also the Commission is doing this. So basically, we are trying to integrate more, but what you look at the level of the markets is a very disintegrated market. So the question is now, will we continue to see more, I mean, a more disintegrated market? Despina was speaking about, let's say, that we have seen more, I mean, retrieval from the European market into the national markets again. Is the national market the more optimal one, or is the European market the more optimal one? All questions still until today. We have seen also that the ECB has done several actions to stimulate this, but the results have been not optimal. Also, we know, let's say, that since I think a week or 2 weeks, let's say, the ECB has announced a new action. There is no growth in European markets. ECB has to take kind of alternative ways of stimulating the economy. The normal monetary policy instruments do not work. What is the ECB doing? Probably very late as compared to other central bank forms of quantitative easing. ECB has announced this TLTRO, saying she wants to put 1 trillion into the markets. So, but what you see, we have room left. We know, let's say, there are big disagreements about this in the board of the ECB. Certainly the Germans, let's say, don't want the ECB to do this. But if there is no agreement, let's say, there must be more stimulus by the European economy. And even, let's say, these recent actions by the ECB so far, let's say, the first announcement, I think 2 weeks ago, let's say, there was limited take-up, limited interest of the banks, let's say, to put these, give these instruments as collateral to the ECB in return for more liquidity. So the question is, let's say, will the ECB have to do what the US Fed has done, have, let's simply buying securities in the markets? That remains the open question. Apparently, Draghi hinted at this yesterday or before yesterday, so the possibility still exists that probably 5 years after the Fed did it, also the ECB will do the same like the Fed. But we will be, to some extent, a victim of the disagreements within the board of the ECB. If you look at the banking sector in Europe, I mean, going more from the macro to the more micro picture, let's say, what also Despina mentioned, let's say, these different sizes of the banking sector in the EU as compared to the United States. Overall, let's say, what you need to know, let's say, that we are heavily overbanked in Europe, depends how you call it. The ESRB just published a paper on the subject, which is very interesting, which is entitled "Is Europe Overbanked?" We have banking assets to GDP about 3 times GDP. United States is 1 time GDP. But then within the EU, we have huge differences. Of course, we now have a single resolution mechanism. Let's say we will solve this probably 10 years or 8 years from now, let's say, in a more European-wide approach, at least for the Eurozone or those which are part of the SSM, to overcome, let's say, this difference between the cost of saving a bank. But we still have huge differences within the EU. You see some countries, on average, as I said, 3 times GDP, some countries where it's still much more, like Luxembourg and Malta, obviously. But then you have other countries on the left side of the scale, let's say, where you have mostly the new member states, which have much smaller banking sectors. The interesting thing is from there, let's say, we have looked at the decline or the eventual decline since 2008 of the banking sector. It has hardly declined. So it has declined to 20%, which is almost, I would say, very limited since 2008. And it continues to fluctuate. So overall, our banking sector in the EU remains large. What is then the soundness of the banking sector in Europe? Which you can look at the equity ratio. It's an exercise which we did. Of course, it's not the exercise which supervisors like the EBA do. They have another way. They have prudential data which we don't have, but we look simply at what we get in the balance sheets of the banks, and you put equity over total balance sheet, and you basically see that since the crisis, the overall equity ratio of banks have increased. So the soundness of the banks, the health of the banking system has improved somewhat, but it remains limited. So the total equity to GDP has gone up from 3.4 to 4.8%. 5%, say if you have 5% equity to your total assets, it remains very limited. There's a person here who is working in the private sector, mostly for non-financial sector. It's 20 to 25% at least you need to have. Otherwise, a bank doesn't want to see you. But the bank, let's say banks themselves, let's say, have much less, which was basically one of the big problems which we had at the start of the crisis. To move to regulation, what have we done? I would say in a nutshell, the big plumbing was done. So we have implemented on one hand the G20 agenda, and we have done banking union. Banking union is single supervisory mechanism is the ECB, which is taking over supervision. Then also this resolution mechanism, which Delphina mentioned, and the update of the deposit guarantee schemes. I will come back to that in a moment. But just, for those which are not regulatory experts, I have put it in a table just to allow you to compare. If you ask the question to me, have we averted the next financial crisis? Just look at the table, what we have regulated today, and where there was no regulation in the past. And basically what you see, all these big chunks, which G20 at the global level, but also we in Europe have started to regulate at the European level, have been addressed. Of course, the first item is probably the most important one, is capital of the banks. And we had capital regulation in the past, which was called Basel II, we now have Basel III. The big difference is that the definition of capital has become much tighter, and on top of that, they have become much more strict. In the past, the bigger you were, the less capital you could have. Now it's just the opposite. You have to add capital buffers, you have to add systemic buffers, the bigger you are. You see on the other elements, derivative markets, rating agents, hedge funds, resolution, we had no European rules, nothing. Now we have rules in place. So overall, I would say the framework is much better than it used to be in the past. Certainly this issue, which also Despina mentioned, resolution, we had no, even at the national level, hardly any rules how do you liquidate the bank. Now we have rules how to liquidate the bank. And the important element of that is that we have introduced buffers, very important buffers, also to allow banks to be dissolved, liquidated on itself, without calling on taxpayers' money. Then we have banking union, probably the issue which I would say about it, but I see the next speaker or the next panel will come back to that, is a bit the asymmetry which we have in the structure for banking union. Of course, we have the ECB now being in charge of banking union, but within the ECB, the governing council is in charge, and the supervisory board, which is the people under Danielle Louis, the French lady which is in charge of banking supervision in the ECB, basically reports to the governing council. So the supervisory function is a kind of a subordinate function of the monetary policy function within the ECB, which could give rise to some problems. So I would say as a conclusion, and then I have one further slide, let's say, with some issues where I continue to have questions. As I said, the big plumbing exercise is done. We have got a huge increase in regulation and supervision. We have new resolution rules, which I think is one of the most important things. We have bail-in, which I probably didn't mention, but there is an obligation before you can call upon taxpayers' money. You have to bail in at least 8% of your assets. Take a bank which has, for example, $1 trillion in assets, like take Banco Santander or ING, 8% has to be bailed in, 8% is 80 billion, so that's a huge amount. On top of that, banks have to contribute to a resolution fund, and banks have to contribute to a deposit guarantee fund. So these are the levels of defense which you now have in the system to avoid banks to calling on public money to bail them out. And supervision has been radically upgraded. I mentioned these different levels. What are the issues of concern to conclude is that, as I said already, our banking sector remains enormous and it has not changed a lot. The financial sector is now very constrained. I mean, there's a lot of rules around. If you speak to people, for example, in the city, they all complain about not being capable to follow what EBA is doing all the time anymore. But of course, have we seen the application of the rules already? Not really yet. I mean, you will have to take another 2 or 3 years to know whether it's working. There also, what I'm concerned with, there are some overlaps in supervision. I mean, overlaps between as well the ECB and the member states, the ECB and EBA. I mean, Despina, of course, didn't speak about this, I mean, it was obvious. Between the ins and the outs, those which are inside monetary union and those which are outside. Between the ECB and the Commission, we now create a new institution in Brussels which is called the Single Resolution Board. The Single Resolution Board are those which will keep the resolution plans of the banks. But the Commission has the plans to engage 240 people for the Single Resolution Board. That is now the big priority in Brussels. And the others like EBA, the boss of Despina complained this week that they don't have budget anymore to engage people, and I can fully understand. They have so many, exactly, they have so many things to do that they can hardly go. So I would say probably we need to streamline a bit the structure of, the regulations which we have in place. Something like we call in Brussels language, there is a need for a refit exercise, a slimming down of a simplification of regulation and a consolidation of the supervisory structure. As I said also in the beginning, for my part, the main problem now is deflation and no growth. And the conflicts of interest which you may have in the ECB between, on the one hand, the monetary policy function and on the other hand, the supervisory function. My big concern is that we may have a Japanese decade or a Japanese 2 decades, as we've seen in Japan since the end of the 80s, and that I think is what we have to avoid at all costs. Thank you.
Thank you very much. I enjoyed all 3 presentations. I have some questions and some comments, if I may. With regard to the latter paper, which Ms. Magos presented very well, my question to him would be whether we could sort of testify a shift of policy orientation on the part of the European Union and the Commission in specific against economies of scale in the banking sector. I remember that as part of the wave of single market, most of the single market or European Union textbooks or policy makers back in the 90s were welcoming the new era of bank mergers and acquisitions. Economies of scale was the key word that was used as a synonym of efficiency. Whether this is leading us again to prioritizing the virtues of bank competition. And if that is the case, I have nothing good to say on economy on large banking, and you very rightfully pointed out the problems of too big to fail. There are, of course, the problems of too big to save, which might be even worse. But the problem, of course, with bank competition, as we know, is that they tend to engender a strategy of adverse selection of risk. That is, they tend sometimes to lead to highly risky exposure of bank institutions, in which cases we might end up with worse problems than the ones we wanted to confront in the first place. The second is whether there is an abandonment of the universal bank principle that was also hailed very enthusiastically back in the 90s, and a return to the according to my view, the good old specialization of bank institutions. I mean, one of the greatest systemic or structural mistakes that started from badly importing American institutions in the European Union was to, we had a very good tradition of the Glass-Steagall Act separation of investment and commercial banking, and then back in the end of the 90s, 1999, this was abolished, and this was imitated in the European Union as something good, and we saw after the crisis that it's not good at all. So will we be seeing more on the part of the European Union? I want your informal estimate, and without an official capacity person, you can speak freely. This is one of the great advantages of being in a colloquium like that. Now, my other question would be addressed to Karel, and it was also pointed out by Despina as well that the well-known bank sovereign doom loop is there with us. Jean Pisani-Ferry had pointed out the impossible triad of having at the same time no mutualization of public debt, no monetary financing, by the central bank, and at the same time the national character of banking systems. One of the three will have to give in, and the guess is open as to what that will be. But the main problem with what we have today is that the process of Europeanizing the banking systems is not sufficiently bold. The balkanization of the banking market remains because the ESM has been, first of all, it hasn't been allowed to go very far. Second, because the banking union is lacking a very crucial pillar, and that is the third pillar of a single consolidated European deposit insurance guarantee. And that means that there's a constant sense of country risk lurking over the banking systems of the periphery, which are already the ones in a death loop with very problematic sovereigns. And this is not bound to be broken. We have a bail-in regime, which combined with the factors that I mentioned, perhaps lead to constant or constantly lurking higher risks in the systems of the periphery. So my question to you both would be, what is the way out of that? And especially, what is the way out of that if we do not move on with the third pillar? And there doesn't seem to be any initiative towards moving to a consolidated deposit insurance system. Now, to you, Karel, I had, if I may, very briefly, a question, more specifically on the alleged conflict of interest that the central bank might have if it also assumes supervisory functions. I think in our case it is highly welcome that this merging of responsibilities is occurring, both monetary policy responsibility and responsibility for the health, the long-term health of the financial banking sector, viewed macro-prudentially. One of the main weaknesses of the Eurozone structure and architecture was the lack of real consolidated responsibility over financial stability. And we saw that what led to the crisis was in one group of countries fiscal recklessness, but in another group of countries financial irresponsibility and a lack of concern at the Eurozone level for financial stability. I think it is a good thing that there is a strong institution that cannot be captured by national banking sectors as national regulators could be, and this has been proven has been shown in the experience of both the US or the UK and other places, that we have this supervisory responsibility in the hands of a powerful European Central Bank. And I think it's a very positive conjunction, it's a very welcome conjuncture if the European Central Bank in this current situation can add the concern of financial stability or the risk of financial instability to the broader risks of deflation. It seems to me that it leads to a much more potent argument than just pointing out the macroeconomic argument against deflation, which is the obvious difficulty that the peripheral economies in the Eurozone are faced, trying to adjust, to restore competitiveness through internal devaluation, with an average inflation in the Eurozone in the level of 0.4, and themselves trying to do all the job by deflating wages and prices. So I wonder whether this is a very good thing that's happening, especially under the conditions of this crisis, that the European Central Bank has this double mandate as part of its job description. Thank you.
Given that I don't see, there is another question.
A very short and rather technical question, I guess. It has to do with the measurement of systemic risks. First of all, like too big to fail banks. I mean, I assume there is a more technical sort of example way to measure it in terms of, spillovers, interconnectedness, actual sort of measurements of size and so on. But what about ex-post measures, right? I mean, when it comes to a failing bank and the actual repercussions it can have, and in terms of spillovers into a wider financial crisis, there's a lot of it, comes down to animal spirits, right, and to sort of investor sentiment and so on. how do regulators anticipate that? I mean, there have been cases of rather small banks that have caused sort of a cataclysm of sort of or a spate of bank failures in the future, which was not really anticipated ex ante. So this sort of ex ante exposed distinction, that's something that actually I would like the regulators in the group to answer that.
So, and the last then question from my side is, I am actually quite astonished, I should have known that, but it seems that the size of the European banks, if you divide the assets of the bank, of the European assets with the European GDP, is 3 times the GDP, while in US is only 80%. The reason I should have known that is, as a market practitioner, I always believe that the complexity of the financial products that the US banks are actually using is much higher than the ones of the European Union. And my question is, can you justify the difference of the sizes to the fact that the SME, small medium enterprises in Europe, they can only actually invest by getting loans from European banks, and in US they can finance themselves by issuing bonds. And if this is the case, then by decreasing the sizes of European banks, that means that you have to develop a bond market for SME lending. Otherwise, you're not going to have growth. Can we start from the reverse order, from Dimitrios and then going to Karel and Panos?
Okay, just add a small addendum to the last question. One of the essential pillars of the new banking union is the single resolution mechanism and the associated single resolution fund. Even taking into account the very important role that is going to be played by the bail-in, do you consider that the funds, even at the steady state of the single resolution fund, 55 billion, will be sufficient? That is, the rest of the architecture may be okay. However, the funds that are there are enough to fulfill the role envisaged for the SRF. Thank you.
To say that these questions picked up on various aspects of the things that I wanted to add, but diverged earlier and lost my time. But if I could pick up on that last point about how you measure systemic risk, like Dimitrios said, there is a list at the international level. There, as a lawyer, I'm concerned because at the international level, there is no decision-making power. This is not a legally binding decision-making, so this is a bit my concern because we are called on a daily basis to transpose Basel Committee agreements, international standards, into law, essentially, in Europe. So there is a list which is defined by the Basel Committee, then there is the European list of important institutions, but then the thing gets more complicated because if you look at the new BRRD, the Bank Recovery Resolution Directive, it has several aspects of that, are passing on the mandates to the EBA to draft technical standards, defining different rules that should apply to less significant banks or different rules that should apply to more significant banks. And I assure you that this is a never-ending story. It is very difficult to define and decide. So there are some criteria like size, interconnectedness, and the size and interconnectedness themselves as criteria have further complications. Size compared to what? Interconnectedness compared to what? So this is a launching board for saying what I'm, for elaborating a bit more on what I was saying earlier, that where it comes down to, where it boils down to having more clarity on the regulations themselves. That is what I was meaning earlier by trying to complete the single rule book and complete the supervisor handbook. And if I may, with your abuse, I will not abuse, touch on a point that Professor Papadakis mentioned earlier about the monetary aspects, which I will translate to my mind as the macroprudential aspects, macroprudential tools that we, the micro supervisors, have in our powers. So again, there are some I mean, for those of you who are not very close to the banking supervision, banking regulation, the CRR, which I was mentioning before, the Capital Requirements Regulation, is that thick. It is that thick. And it is completed by hundreds of technical standards that we draft. That's my job, actually. I draft these technical standards. Now, that is my full-time job. That's why I don't know much about resolution, etc. But the CRR is that thick. Nevertheless, on the macroprudential tools, which is a very noble idea, very noble idea, it means that a supervisor at any point, when they decide that there is a risk building up in their country, they might decide, for example, to change the risk weights that you put on the assets. So the way normal regulation works is that if you have a risky asset, you might have given a loan out for 100 euros, but because this guy, you don't expect them to pay up very soon, they're not in a good condition, you actually put it in your books as 200 pounds, or instead of 100 pounds, or euros, whatever. So this is a very basic part of the whole regulatory edifice. So we have written all these rules, which we negotiated with so much pain and tears, but then the macroprudential tools allow the national supervisory authorities to even deviate from that. This is necessary. It is an absolutely necessary thing to happen, and we wish, as EBA, some of these countries that had problems, in Spain, for example, especially with a state bubble, they could have these tools in their hands to apply them. But again, I will speak now a bit more as a lawyer, but I think it's the same for the economist. You want to make sure that these tools will be used across Europe in the same manner. So that the same will apply to Greece, Italy, Spain, and UK, and Germany in the same circumstances. How do you achieve that? You have to harmonize a bit more the substance of that, irrespective of who is the supervisor. You have to make sure that that the rules are put in place. And I'll put something else which is purely I'm speaking my own mind, but as a European citizen, even if at some point there is no SSM and the ECB takes over the supervision of the banking sector in the whole of the EU, as a European citizen, I would still like to see rules in place for how the ECB applies these policies in practice. So as a citizen, purely, and I'm disclaiming that this is not a approach, but I am sometimes scared by centralizing too much, and I'm linking this to this morning's session, because in this morning's session I was a bit. Now, I realized that this morning we were speaking about more democratization in the way of the European Union, which is hopeful, but now this is more technocratization. So our sessions are on they're speaking about the opposite action. It is needed, so it has to happen, but it has to happen with the correct way. It's difficult, but thanks. I think I have nothing else to add.
Thank you. Karel, please.
I'll try to be quick. I mean, this is a whole set of questions. Even first of all, let's say on the question, let's say on the whole. I mean, referring to this trilogy of language, we have to address some of these issues. First of all, the thing which I did manage to explain, we have a deposit guarantee system in place now. We have a harmonized system in place, and the most important thing is that so the third element of banking union, it was in my slides, has been addressed. We don't have a European-wide system, but we have pre-funding. Meaning 0.8% of eligible deposits has to be put in a fund. They must be paid out 10 days or so after failure of the bank, very clear rules. And on top of that, you can borrow between schemes. Meaning, if a cross-border bank fails, I mean, you can put a scheme into motion to make sure that a payout can happen very rapidly. And that there can be loans between schemes up to 5 years, just to make sure that a large cross-border bank can be bailed out. But you have to see this in combination with bail-in, resolution fund, and the deposit guarantee systems. On top of that, I mean, I would add that deposit guarantee schemes, if you do the total funds available today in deposit guarantee schemes, even before the crisis, were probably 3 to 4 billion. If you were to have the 0.8%, you would have 80 billion in place. Because if you measure more or less 1% of the eligible deposits and the union would be 100 billion. So we never had rules on pre-funding of deposit guarantee schemes. Even if, for example, Germany said we have a deposit guarantee scheme in place. No, if you look at the Germany scheme, for example, there are a lot of commitments, but hardly any money in the funds. So we have this now in place. You have to also add this to the issue that consumer protection remains a host country issue. It's not a home country issue. It's a responsibility of the member states. So you're a large bank, you're active everywhere. So you have to be bailed out for the consumer deposits. That remains a host country responsibility. For my part, it does not necessarily need to be kind of one single large fund. If we have these other elements, I think it is sufficient. So if we were already to have this, let's say it would be a big step forward. Of course, the big question mark is the transition period. It's take 8 years to get there, so meaning the cost of the banking sector to pull this up is large. I'm most scared about the transition period. But for this transition period, there was also another question about this. The ESM, European Stability Mechanism, has agreed that it has in its 500 billion which it has available. There is a tranche which is available now for this crucial period between now and say another 2 or 3 years for the banking sector. So the ESM can force states, countries which haven't got sufficient funds for the banking sector, use money from the ESM to eventually recapitalize banks. So as soon as in 2 weeks the ECB publishes its asset quality review, we see that some banks are recapitalized. The first thing which has to be done is bail-in. If BRRD is not yet applicable, so the bail-in will only apply to subordinated debt. Formally, yeah, you know it because you were in Digicom. From 2016, the bail-in will apply, like what we did in Cyprus, also to deposits, eventually, above 100,000. And if you see that even then a bank is undercapitalized, you can go to the ESM. But of course, the ESM requires unanimity from all the member states, and member states of the ESM, of course.
I hope not like it was done in Cyprus.
Sorry?
I hope that it's done better than it was done in Cyprus.
ECB conflict of interest, I mean, I'm also in favor of, let's say, the ECB moving, getting back to supervision, and I was very happy we had this Article 127.6 by which we could do it without a treaty change. I just wanted to, I mean, erase some issues where I could have some concern, let's say, of having too much power, and the discussion a moment ago went already in this direction. But I would just say, if you were to be Draghi today and you see an asset quality review coming and you see, there's some bad banks in there, what shall we do? Shall we just say, no guys, boom, we tap upon the banks, you need to go to the markets, you need to raise capital, or you say, shift it through. In the current circumstances, if you're the governor of the ECB, you say, let's slide it through. We will not risk, for financial stability reasons, economic instability today. And that's the danger of conflict of interest. In the past, of course, there was a problem because the ECB never had the data to know what is the banking sector about. That's why, for example, they said, look, finish now. After Bankia, we were giving plenty of money to Bankia as collateral, return for collateral, and Bankia was basically an empty shell. Of course, now they will have the information. But I'm just afraid, let's say, that at some occasions, if in the end, as I said, the governing council decides on monetary policy reasons, they want to maintain financial stability, they will see some of these issues through the fingers. I mean, that is, I think, a non-negligible risk. How to measure too big to fail banks? Of course, very difficult to say. It depends on every bank is different. It depends on what is on the balance sheet of a bank. And don't underestimate, if you're a very traditional bank which basically has on the asset side loans to enterprises, if the bank fails, try to get money for your loans. If you have securities, like a Deutsche Bank on the asset side, you can sell your securities. If you have loans, you probably get 10 or 20% of the value of the loans. I mean, so meaning it's extremely difficult to say, let's say, which bank is too big to fail. It depends on the structure of the asset side of their balance sheet. So it's also difficult to say, let's say, what, I mean, if you look at that size, let's say, what bank would be too big to fail and what not. I mean, it depends on what is on their balance sheet and how easily you can sell these securities or, let's say, the loans or whatever, let's say, is there. Then to stimulate, let's say, also, for example, SME financing, I mean, to have the issue of the bond market and so on. I mean, I don't think...
Between the balance sheet? Is because of the SME lending?
No, that's the other question I want to say, just the question you asked, let's say, about... I mean, I don't think, SMEs probably may be tapping the bond market directly a bit more than in Europe, but not that much. The thing is, going to the bond market, certainly for a small enterprise, has a cost. The big issue which the United States has got, there's much more money for risk financing, which is basically equity financing, which we don't have enough in Europe. And that's the biggest problem, which we see with the Twitters, which we see with Googles and all these. If they have gone to the market, say Google hardly existed 15 years ago, and today they are, why do we don't have this in Europe? I don't have the answer. Apparently it has to do with risk aversion, incapacity to bring innovation to the market. So many intangible things which I think thousands of people are struggling with in the institution to say, look, how could we find a way to overcome this? But it also has to do with this other issue which is now on the table in Brussels, capital markets union. All markets are further fragmented. I mean, how do we look at markets in Europe? Let's say the Greek look at the markets, the Greek capital market. The British is the British capital market. French is the French capital market. We don't look at the European capital market. If I read my newspapers in Belgium, for example, I read about Belgian stock. I couldn't care less. And Belgium has only a few stocks which are of interest. I want to have a view of European stock. Which newspaper gives me information about European stock markets? Hardly any. Or about European bond issues? Hardly any. And that's, I think, the main thing. If I want to buy, for example, interesting German bonds, I mean, even as a private investor, I have to look very far. If I call my bank, and my banker says, sorry, I don't do it. So I have no German bank, let's say, which I have money. I would have to call Germany to buy German bonds, because the Belgian banks do not sell these German bonds. So that's part of the problem. I think it has a lot of structural problems. Let's say, if you want to create a capital markets union, it's above all shake the markets and really create a European attitude towards European markets. But I think we have gone backwards on this rather than to go forward. I mean, there is insufficient kind of awareness about the importance of Europe from so many perspectives. This SRM issue I mentioned already, the bail-in which we have now, let's say the fallback position which we have now through the ESM. But that's it in a nutshell. Thank you.
Thank you, everybody.
Could I add a final comment, if it's not too late? Again, this is personal view from my personal experience, but I think I would disagree on one point that Karel said. I think I would add a bit more urgency on the deposit guarantee scheme part of the banking union. I think my chairman has spoken about it a bit with caution, so perhaps we could wait for a while. But I'm saying this because, again, in my role as lawyer who looks at technical standards, we have to do some technical standards. I think we're starting to look at technical standards that specify this pre-funding of the DGSs that you mentioned. But yes, but what I found, I was flabbergasted to see that one of the assets, so when you go to the detail, that's where the devil is, and I was flabbergasted to see that one of these types of assets that are recognized as funding is guarantee for future, so something which is not really, it ends up beating the aim of the pre-funding, which we cannot do anything about because it's written in the legislation, so this is our mandate, so we have to work within that. And that, I think, is the link to the political, let's say, discussions. There has to be some political will to do some of these things. So, on the capital markets union, again, we have our sister authority, the ESMA, which is based in Paris. And again, I don't have a very good view of the market, so probably you have a better opinion on that. But from my point of view, because we've been working with them and following their legal acts which they implement, there's also been lots of progress with trying to create a single securities market in the EU, but I think ultimately probably it is a question of also creating the mentality for that. But I think structurally, so ESMA has actually been given even direct supervisory powers over some aspects of the market, so credit rating agencies. So hopefully this is moving to that direction. There are many academics who have been speaking of urging banking, and of course Eddie Weimers, who was the Caesar and ESMA chair, has been looking to that. But I think it might be also historical reasons up to a point, so historical structures. Thanks.
A quick addition to just the deposit guarantees. I mean, you have to keep in mind if you want to create a single fund, you have to expropriate other funds to bring them in a single fund. It was easier to create a single resolution mechanism because you start from scratch. But if you create one now, you say, I've been in a meeting where the Spanish went to Germany, we want a single fund. The heat of the crisis, the Germans would say, they're just foolish, these guys. Do they think that we will just give more funds to them? Also on top of that, the German private, deposit guarantee schemes are private. Are not public.
But can I
think not all of them. There's an option for, I think there's an option. But yes, it can be also private.
Can I ask you just a last question? Do you really believe that we are done with this country risk overhanging the southern Eurozone economies for years? And
what does that mean for the cost of capital? I mean, any adjustment that will be achieved to unit labor cost reduction will be swallowed by the higher capital cost. There will be dynamics of capital fleeing from the periphery to the core, as long as this country risk is there. And a part of this country risk is the fragmentation of the banking system as a result of the lack of a fiscal backstop at the eurozone level for deposit guarantee systems.
I agree, that's why I showed this slide at the beginning. But we have seen it already at the governance level, thanks to what the ECB did, let's say, with the what they announced a year ago, let's say they could purchase bonds. Now the yields are more or less at the same levels. Okay, of course, 40, 50 basis points. We have gone through this. So let the markets adjust. I think it will come. If, of course, the market integration comes back.
Thank you very much. I think that we're going to have plenty of discussion also on the next panel. It's time for the coffee break. We are going to reconvene in 15 minutes. And I need the panelists for short interviews. Thank you very much.